Hi, and welcome to this morning's early concise highlight. It is currently 8 a.m. on Wednesday, March 30th, 2016, and we're coming to you quite a bit later than usual because we wanted to see two things. One, the ADP employment number, no surprise there, it was up right at 200,000 as expected. We wanted to see what Janet Yellen's fellow dove at the Fed, Chicago Fed President Charles Evans, had to say in a morning interview, and in fact, he was reinforcing the idea that the Fed really isn't that keen to raise rates while global conditions are so weak, which is just what she indicated yesterday and then some. In fact, if you look at her speech overall, and there is a copy of it that's got some mild markups in it in today's Rohr-Blog Concise Highlights post, and you can link out to that, she basically was quite dovish and alluded to the degree to which not only are things weak, but that no one should assume where the rates are going. If conditions weaken enough, the Fed would be willing to both once again ease on the rate and furthermore actually go back and reinstitute quantitative easing. And of course, this was quite an encouragement for the stock market. And so we have to ask what all this meant to the markets. And in fact, the S&P, you can see what it did yesterday, and we already prospectively, as we're getting close to the opening, put in the fact that it's trading up near 260 today. That's been the high end of where it traded overnight, and it's up there now. So our view is you have to respect the 260 area as where we'll probably have to reset this Fibonacci. It might end up going even higher, but presume that, and look at what that does. It ends up making the 25% retracement that had been down at 208. Remember how we used that as a tolerance if it should challenge 210. It is now around 217.5. So in other words, even if the market should get back down into the top end of 220 to 210 once again, 2020 to 2010 once again, that would reinforce support. Now the other thing is, it wasn't surprising, in spite of the overbought condition, to see the upside follow through this morning, because by later on yesterday, as the market held up and ground higher, both the 30-minute and hourly MACDs escaped the upper runaway band. And here we are up into 2060, which is above the previous 2050. The market just missed last week, Tuesday, before the comments from Patrick Harker from the Philadelphia Fed that were more hawkish. Dudley's subsequent comments drove it down. And here are all of your hawkish comments implications. We note that even coming out of Monday evening into yesterday morning on Tuesday, we had comments from San Francisco Fed's Williams. So what did Janet Yellen basically do? As soon as the text of her speech was released, you'll notice that this market pushed up. As a matter of fact, for a better view, she didn't actually start until right into 11 o'clock Central Time. That was about 30 minutes later than expected. And where did it end up? It ended up with immediate push higher. What basically happened was the big dog said, forget what all these minions from out in the regional Fed headquarters have to say. Harker, Dudley, Williams, we're still data dependent. And right now the data is weak, and we have extensive confidence in our ability to fight inflation, even if it should pick up. And of course, this gets back to being what we had said, the effect of the Fed moving the projections from four rate hikes during 2016 that had been implied since the December meeting. The projections going back to 2 weeks ago today said, nope, it's only going to be two. It was the equivalent, effectively, of an anticipatory 50 basis point rate cut on the outlook. And of course, The market had responded well ever since. If we go back there, you can see how in the wake of that, the June contract had pushed above 2020 in its own right and ultimately ended up maintaining support at 2020 to 2010 in spite of what the folks from the other Fed regions had to say. Now, 2060 is the next interim resistance now that it's exceeded 2050. And of course, 2035 was the key interim level it tried to stay above, but had to react back below. And the next resistance is the bigger resistance up at 2075 to 85 we're going to explore in the intermediate term charts. And that pretty much does it for the short-term view of the S&P 500.